Hey guys, it's Max Convexity. Hope everyone's having a good day. Let's take a look at this study. When I was talking with Jay yesterday, I referenced a study that says you need to reinvest two-thirds of your dividend income to avoid any type of bad situation with the NAV. Well, the study doesn't really say that. I found a study and I made an interpretation. Uh, and I made a video about it, and I think I stand by what it says basically, but I want to kind of refresh that. That video was when I first started. So today I wanted to try to do a quick, too long, don't read, maybe a quick recap of the of that study and why I think this is such an important uh paper. Okay, so what these guys did, we always talk about managing distributions. I think Jay mentioned it yesterday, but other channels mentioned it too. But that's what XYLD gives you is managed distributions. They make a lot more, and they reinvest it for you, and they give you whatever they give you. Same thing with the JP Morgan funds. It's a managed distribution game. That's one game that for better or worse, Defiance and YieldMax are not in. So that's why I found this study. We kind of have to do that ourselves, in my opinion, to avoid any type of bad situation. So all this is okay. This looked at the different benchmarks. You heard me asking Jay about the benchmarks. They have multiple benchmarks for what's called a buy right, which is a covered call strategy, and they have ones that are at the money and ones that are out of the money. Well, listen to the first line of the study. This study's from 2016, but it's like it's no shit, right now. But it says although the S&P 500 buy right index, the leading buy right benchmark, writes at the money monthly options, a market participant may be better off selling out of the money options and allowing the equity portfolio to grow. Yeah, and we talk about that all the time on this channel and multiple other channels. And then in the second line, he describes what the problem is exactly. Equity growth serves as another source of distribution if the option premium does not meet the distribution target, and it prevents the equity portfolio from being liquidated too quickly due to cash settlement of the expiring options. In other words, erosion of the account value, not option erosion. I mean, but different kind of equally bad type of erosion, worse type of erosion. You don't want your account value to erode. So all these guys did is they did a study, but they managed the distributions. And this is from 2016. And I bet you all those hedge funds have read this paper. And I would bet you this BXY index, which is a out of the money buy right on a monthly. I bet you that's pretty much what JP Morgan's trying to replicate, because I've seen studies where the BXY outperforms buy and hold, which is just outperforms just passively owning the index. And the old thing they teach you about option selling is it almost never outperforms the underlying, which is true. It rarely does. But BXY has a pretty good combination, evidently. I'll try. That's another study, but there's multiple studies on this. So here's what these guys did. They took the BXM, which is basically what XYLD does. That's the global X at the money. The BXY, which is out of the money, more akin to the JP Morgan and most of the other ones, FEPI and there's and then there's different variations. These other variations down here, conditional buy right, these are what I would call target, where they're just trying to pay a portion of it. But anyway, and that's similar to what SpyT's doing, and there's other ones, and there's other companies too. So they said that since most studies have investigated the risk return profile of buy right strategies, this paper focuses instead on the distribution aspect of the strategies. We believe this is an under-addressed issue that income-seeking market participants may want to be aware of. To build an efficient income-generating portfolio, it could be best to look beyond the dividends and option premiums received and consider the speed at which the equity portion grows or doesn't, or the principal is diminished. Yeah. The following steps describe our methodology. So anyway, great paper. So now I'll give you the too long don't read. This shows you the monthly premium they were able to get. And this basically just shows you the more volatile the market is. You can see this study took place in a really, really shitty 10 years for the market. People always say, I wonder how these would do in a bear market. And it doesn't get much more. much more bear than 2008, 2009, or 2009, whatever. But anyway, and the rest of the decade wasn't great either. 2006 wasn't super, but in any event, so this is the premium these guys got, were able to get on a monthly basis. Now, they didn't pay that much. They only paid a portion of it. So the distribution plans. Okay, so here's the Global X strategy. This is at the money. It's at the money and it's different distributions. Okay, so if you had an at the money strategy and you didn't reinvest any of it, yeah, look, by 2008 you were down, 40%. By 2000, you could see it was ugly, and you're done for. Even if you reinvested a portion of it, 12%. These plans make about 20%. I mean, if you average all those months together, they make anywhere between 18 and 22%. So 12 is taking about half of it. Even on a half reinvest, you still have a lot of erosion, a lot of capital erosion in your account value, like in half. Okay. But if you reinvested, okay, if you only took 4%, which is about a fifth of it, this is the worst study because this is the worst strategy. And I don't know if worst is the bad, but this is the least aggressive strategy or the least bullish strategy, maybe. I don't know. Anyway, but you could see, over this really bad 10 years, your NAV was steady if you just held on to, if you reinvested most of it, basically. 4.5 is not that much. That's just a fifth of it. So this is the worst study. And then, of course, if you want to reinvest more, you do better. Okay. So then they'd study the impact of moneyness. And this means, let's do out of the money. And that's BXY. And you can see it's a lot better test. And the results are better. Even if you would have not done anything, you didn't have as much, erosion as up here. This one, the account was gone down to 10%. This one, you cannot reinvest anything. And after 10 years, you still have 40% of your account. You could see they all lose money in 2009. I mean, there's no way to hide it. Everything's going to lose money when the market does that, but the ones that reinvested a portion of it, continued to grow or whatever. Look at this one. So 6% distribution. And they, like I said, they make 18 to 20. So that's where I came up with okay, we're going to keep a third, pay ourselves 6%, reinvest the rest. And over like the worst 10 years I can think of, a really bad 10 years, we should be our NAV should be flat. So the theory is if we needed, to rely on this amount of dividends, to have the NAV steady, because we're trying to live off the income, we want a steady NAV. So we would want to reinvest 2/3. And of course, the reinvesting 2/3 deal probably actually kind of worked out when the market went down, because you buy at lower prices, lower your average, then when the market recovers. I mean, that's the theory. If you're in it for the long run, you're all right. But if you're in it for the short run, or if you just take all the money out, yeah, you're cannibalizing the account. Here's the monthly premiums. I had to average these to figure out the fractions. I kind of had to extrapolate that, and also, okay, Jay was saying yesterday they don't have dailies. And I realize that, and they don't have daily benchmarks because dailies haven't been around long enough. But I'm saying this study is just studying. It wouldn't matter what the asset was. It could be any generic asset that returned total return what covered calls did, but also had the other side. It could be any asset where you're cannibalizing it, where you're taking money out of the asset. This could be bonds or whatever. So this could go for anything. It doesn't have to be options. So I think on the dailies, the same fractions would hold true. You have you make different numbers, but I would still think the third is a safe, even if it's on a daily strategy. So anyway, okay. So this one right here is like a target fund, and you could see. So this would be what I would call the least aggressive, similar to SPY-T. Right? They aren't going to even take everything. So you could even do one of these funds, not invest anything. And after 10 years, you still have 80% of your capital. That's pretty good. I mean, you know what I'm saying? If you're cool with that, because this is the least aggressive one. But even on this one, if you only paid yourself a fraction, 6%, which is about a third, of what you could pay yourself, you'd be fine. Okay. So here's a little bit more aggressive target fund where, So one's 50 bips, one's 75 bips. But you can see this is a really good study. Okay, so this is the worst one. This is a weekly at the money, and I don't even know of a fund that does this. There's weekly strategies, but which is yield max, but they're way out of the money typically. Anyway, you could see a weekly at the money strategy, no dividend reinvestment. I mean, that's bad. But even if you just can hang on to a little bit of it, about a third, and you're flat over the worst 10 years in history. So here's another one. Here's a quarterly, and I really didn't get into quarterly, but it's all the same. It's always the keep a third, reinvest two thirds. Okay, and they even did a study on this. I'm just going to link to this study, and I'll let you guys look at it. But there's dividend aristocrat ETFs out there, and they even did a study on that strategy and what would happen on that strategy. I just saw one the other day. I forget the symbol, but I think it may be like King or something. I don't remember exactly what it was, but it's a dividend aristocrats. So anyway, the conclusions is a buy right strategy essentially trades part equity growth for upfront option premium. As the option strike gets closer to the spot price, the market participant usually collects higher option premiums and gives up more upside in the underlying equity. Given a predetermined distribution goal, the equity needs enough room to grow to prevent the portfolio from depleting too quickly. Steady income stream. Although one can always liquidate part of the equity portfolio to make the predetermined distribution goal, a steady income stream from the option premium and stock dividends may be desirable for those seeking income, I would say. For this purpose, market participant may consider selling options based on the option premium rather than the moneyness. And that's the target strategy, I believe, as a traditional buy right portfolios do. The trade-off is the overall portfolio usually ends up with a slightly higher volatility due to the fluctuation of option strikes. All right, so and then it says market participant may also want to consider selling S&P 500 options against other income-generating indices to provide the portfolio's distribution capability and terminal value to improve. I'm sorry, yeah. You definitely want to improve the terminal value. If the index is highly correlated with the broad equity market and if the options are cash settled, the basis risk should theoretically be manageable. That last sentence right there is the basis for a lot of funds, but I'm thinking of Maxi right now, MAXI. They sell S&P options, even though they're underlying. Don't they own Bitcoin futures? I'm trying to think. I think they own Bitcoin futures, but they do S&P options. But then there's another one out there that actually does options on BITO, and I get them confused. But in any event, so the thing is, you could use two correlated assets. In other words, Bitcoin and S&P. And Bitcoin, you could have a fund that owns Bitcoin and does S&P options. I think THTA does that also, and that's a J fund that I did not ask him about. One of the many things I did not ask him about, but that supposedly is a bond fund, right? It's a treasury fund, but they sell spreads on the S&P on that fund. Basically, I think they do iron condors. Anyway, all right, enough option nerd talk. But this is a great study. I'm going to link to this. But yeah, the caveats are it's not for dailies. I think the fractions would apply to dailies, but I would be interested to hear what you guys think. You guys have a good day, and I will talk to you later.